Welcome to the Nick Huber Show. I'm going to give you a breakdown of how basic real estate private equity firms are structured. I run a real estate private equity company under the flag Bolt Storage. We raise money from outside investors, LPs, limited partners. We raise money from LPs to buy real estate and put together deals. I am a GP, general partner, or a sponsor. Now, how does the money get divided when you raise money for a deal? Now, first of all, the GP has the team. I have the team. And my goal is to make our limited partners money and also make money for myself. But when you buy a deal, you have to put some of your own money in, generally. Now, let's talk about a couple different factors. The co-invest. That is how much money is the GP investing alongside the LPs. There's two different share types in a deal. When you build the operating agreement, which is generally an LLC, there's common shares and there's preferred shares. Now, who gets what? Now, the GP, me, the general partner, I get what's called common shares, and those are not really triggered, and the money doesn't flow out to them until you hit certain waterfalls. That's another term. Think of a waterfall as the money bucket fills up to a certain area and then it pours into the next bucket. That's how real estate private equity works. So let's say we have a deal where we raise money on an 8 pref. Now there's another term, preferred return. This is what's promised to the LPs before the GPs get paid. If there is an 8 pref, that means the first 8% of all yield, and that's on a yearly basis. So it's an annual rate of 0.001% or something along those lines every day. I mean, it's a daily rate and it's calculated on a monthly basis or quarterly basis to add up to a yearly amount. It's like an interest rate. Think of it as an interest rate on money that you borrow from LPs or investors. So if an LP puts in $100,000 on an 8 pref, the first $8,000 in profit that year will go to the investor. And once you hit that waterfall, that hurdle, that 8% hurdle, what happens afterward? Now you're into something called the promote. Now the promote is what percentage of the returns beyond the preferred hurdle that the GP, me, the sponsor, that I'm entitled to, the common shareholders, what amount of money goes to them. Now, when I'm raising money for a deal, I'll get outside investors to put in almost all the cash. And ideally, I can get above that pref so that I get a percentage, a portion of the income or the promote. Now, there's aggressive structures. I run an aggressive structure. I take a 50% promote, meaning everything over that 8% preferred return, and the preferred return can be 6%, 12%, depending on how risky it is, depending on market, depending on investor appetite. The deal structure generally changes. Now, beyond that preferred return is called the promote, and it's what percentage goes to the GP. 50% of the profits over an 8 pref is what I take on some of my deals. If it's a new development, if it's a riskier deal, if it's a much larger deal, and maybe I'm not doing a 10% co-invest, that can shrink all the way down to 70-30, 80-20 even on a lot of new development deals. So the promote may be 20%, meaning anything over an 8 pref, 20% goes to the GP or the person who puts the deal together. 80% goes to the LP, the investor. They get most of the upside. Say it's a high risk deal, a new development. There may be like a 6 pref or 8 pref or even a 12 pref and then a 20% promote, meaning beyond that hurdle, when that hurdle is hit, when the 10% return or the 12% return is achieved, anything beyond that, 80% goes to the investor, 20% or 20% promote goes to the GP, the sponsor. So a lot of times, folks like me, we're chasing upside. A sponsor is chasing upside. A real estate private equity guy like myself is chasing upside because I only get paid if a preferred return is hit. And that preferred return is often a respectable return. So there's also something called fees. Now, I have to run a company. I have to hire my employees. I have to pay all my people to do things like send tax returns and manage the money and operate the deal and acquire the deal. All those things take work. So there's often an acquisition fee. Now, an acquisition fee can be as low as 0.5%. They can charge no fees, or it can be as high as 3.5%, which is what my firm charges on a very small, high-touch, off-market deal. And most of the time we bonus out our acquisitions guys 75 or 100 basis points and so on. That goes to my team to do the work to find the deal and to close the deal. That's called an acquisition fee. And it's generally calculated as a percentage of acquisition price. If we're buying a $1 million deal and we have a 3.5% acquisition fee, that's a $35,000 acquisition fee. A 1% acquisition fee would be $10,000 on a $1 million deal, and so on and so forth. There's also something called an AUM fee, assets under management, because having investor capital, if you're going to raise, say, $10 million of investor capital, which is about what my firm has under management right now, it takes work to manage those investors, to send the money to the right places, to keep everything straight, to do the bookkeeping, to get everything done, to file even tax returns, right? That is generally compensated by an assets under management fee. And those can range from 0.5% all the way up to 2% sometimes. We charge 1% asset under management fee. So if we're raising $1 million on a deal, $10,000 a year is an expense that will be put towards our company to pay for our CFO, pay for our software, pay for our overhead, pay for the people that we have to hire to manage the money in that deal. And remember, the asset under management fee is very rarely on the entire purchase price. It's on the amount of capital, the amount of equity, the amount of cash in the deal. So you have also a management fee to run the asset itself. Generally, that's calculated before NOI. So it's not really a real estate private equity deal. But as far as real estate private equity goes, you go out and raise money from what's called LPs on a preferred return and a hurdle. And this is just one way. There are many other structures. There's a straight split, meaning right off the bat, no matter what, there's no preferred return. It's just 75% of profits go to the LP, the money people, and 25% of profits go to the GP, the sponsor. Now, you can structure them however you might want, but that is the basics of how real estate private equity works. So when you hear us talk about prefs and hurdles and GPs and LPs, hopefully you know that the GP is the person putting together the deal, the person executing the deal. The LP is generally a passive, quiet investor. LPs who put cash into deals, there's accredited investor laws, meaning they have to have a certain amount of net worth, a certain amount of cash, a certain amount of annual salary to be a qualified investor in private real estate deals. They're called LPs. They put in capital. They look at the pitch deck. You pitch them. You go talk to them. You ask them for money. And eventually they sign the operating agreement and they wire you the money to close on the deal. Now, there's fees, there's the acquisitions fee, there's the management fees, and there's the asset under management fee, the AUM fee, and then there's something called a preferred return. That preferred return, is generally a percent, and think of it as an interest rate. If you're raising money on a 8 pref, that means think about it as the first 8% all the time goes to those investors before you get paid. So if your cash flow is below that 8% for a while, there's often something called catch-up or clawback, where investors, if they don't hit a preferred return, there's stipulations in the operating agreement that tell you where and how the money is divided up. Now, there's also disposition fees. Just like there are acquisition fees, there's disposition fees, meaning if you sell a property, you get compensated 1% or 0.5% or whatever it might be. If you refi, there's refi fees, because all these things take work. Selling a property takes a ton of work for management. Refinancing a property takes a ton of work for management. So if you do these things, you can charge fees for these things, and they generally go to the GP, the sponsor, the person running the deal. So if you are a real estate investor interested in investing in private real estate deals, these are the questions you need to ask. What's the pref? What are the fees? What's the promote? What are the different waterfalls? And a waterfall meaning up to, maybe it's an 8 pref, so the first 8% of yield goes to the investor, up to a 12. It's a maybe a 70-30 split, meaning 70% goes to the LP, only a 30% promote above the pref to a 12, meaning a 12% return. After a 12% return, maybe more goes to the sponsor, because the sponsor, me, if I do a really good job and everybody earns 12% on their money, maybe I get even paid even more beyond that. Maybe it's a 50% promote over a 12 or over a 15 or over a 20, what's called an IRR. And that's what's called an internal rate of return. And IRR is a word that you throw around often. And that's just basically when a deal is finally done, when a deal is over, when you sell it, when you refi out all your capital, whatever it might be, what is the total return? You take it, the amount of money that was returned and the time frame, 3-year time frame. Maybe you double your money in a 3-year time frame. That's a 33% IRR, because you've made a 33% return every year on your investment. It's basically the interest rate on that capital throughout the life of the deal. Now, there's also a multiple on invested capital, MOIC. You'll see that on some deal documents. MOIC means, okay, throughout the lifespan of this deal, might be 5 years, might be 7 years, what's going to happen to my capital? How many times is it going to be multiplied? A 1.5 MOIC, a multiple on invested capital, means you're going to make a 50% more money than you started with. You're going to make 1.5 times your initial investment. A 3x MOIC means you're going to triple your money in the lifespan of a deal. And those are all different aspects of real estate private equity. And sometimes there's hurdles beyond the MOIC, meaning if you do certain numbers with the invested capital, anything beyond that can be paid more or less to the sponsor. So there's waterfall provisions inside of deal documents. And the waterfall provisions says, where does the cash go? How is it divided up between the common shares and the preferred equity? The preferred equity being the LPs, the limited partners, the investors. What over certain hurdles, where's the money going? Up to an 8 pref, maybe it's all going to the LPs. From 8 to 12, maybe it's 70% LPs, 30% promote to the sponsor. Above a 12 to 15, maybe it's a 50-50 promote. Maybe it's 50% to the investors, 50% promote to the LPs. Sometimes you even see it flip the other way beyond really high hurdles. Maybe over a 20, you have a 70-30 the other way. A 70% promote, 70% to the sponsor, 30% to the investor. Now, how do you structure a deal? How do you think about structuring a real estate private equity deal? Now, it all depends on the market for capital. If you have a really easy time getting capital, you can get very aggressive with your terms. If your deal is risky or you don't have a lot of access to a lot of capital, the capital calls the shots. And you may have to offer a really high preferred return with a really low promote. And you as a sponsor, you might not make very much money. How much are you co-investing? How much of the actual LP shares are you going to take? Because a sponsor very often is expected to own both share classes. You're an LP and you're also the GP. That means you need to put some of your own cash at stake. Is the sponsor co-signing the debt? Meaning, am I personally guaranteeing the debt on the building? That's value, right? So that may warrant a lower pref and a higher promote for the sponsor if they're co-signing the debt. How juicy is the deal? How good is the deal? How good is the management of the sponsor? Me in self-storage, I consider myself a very good manager, and I can find deals and we can buy deals that almost nobody else can. So therefore, I'm entitled to charge a lower preferred return and a higher promote, more in the deal for me because our deals are good. So it all depends on risk-adjusted return, the amount that you're entitled to as a sponsor really depends on a lot of different factors. And we're going to go into, throughout the show, we're going to go into a lot of different depths on real estate private equity. We're going to talk about IRR. We're going to talk about hurdles. We're going to talk about prefs. We're going to talk about co-invests. We're going to talk about fees. I'm going to tell you what I'm learning about raising money. And that's it, guys. We'll talk more. Hey guys, I have big news. I recently revamped my sales and customer service team at my self-storage company using folks in South Africa. Listen to this English accent.
Hi there, my name is Anton and I'm a sales professional from Gqeberha or Port Elizabeth, which is in the eastern province of South Africa. I've been in sales for about 8 years now with experience in hardware sales with some of the leading brands in the world, such as Canon, Panasonic, and more recently Red Bull.
Okay, now the surprising part. The person you just listened to is available for hire right now, and they're asking $9 an hour. If you want an introduction, if you want to hire this person into your business or at least interview them, send me an email, nick@sweatystartup.com, and I can make an introduction and offer you $1,000 off the recruiting fee. nick@sweatystartup.com.